Hello, my name is Eddie Tofpick. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Service International Limited. As is usual at this time of year, I have forgone the usual daily charts and instead I have concentrated on giving a longer term view using weekly, monthly, even yearly charts, but rarely using daily charts. Now, if you would like to discuss any of these charts, I'd only be too happy to take your call. So without any further delay, let me introduce today's longer term chart. Today I'll be looking long term at ICE BRENT crude oil futures. Be warned, this is actually quite a long commentary. Last year I wrote so much on the annual review of this commodity that I had to change the font size to accommodate it all. It was not an easy review to write back then. To give you an idea, here is how it started, and I quote, "This monthly chart has to me been by far the most difficult to interpret. I've had to sleep on it and do other mental exercises and invocations as I was having real issues with it. Even now, I think perhaps I have only a glimmer of the truth, but it is like chasing phantoms and grappling with ghosts." That's the end of the first quote. I continued back then, and I quote, "This all led me to pose the question out there last year, and one that is still not fully answered." And I quote, and this is again from 2 years ago now, "Is the action from 2014 a type of descending scallop pattern?" End of quote. Okay. So, we are now a year later, and what can we see? Well, the answer to that question is yes and no. I said this commodity was giving me issues. The best way to describe it is to look at the parameters I wrote for a descending scallop pattern back at the start of 2020. And I quote here again. Now, a descending scallop pattern can be both bullish and bearish. In the case of a bullish scallop, the market takes another more ragged and shorter dip. That'd be late 2018 to date, or as I wrote last year, the end of 2019. Before then, accelerating higher. The part that is yet to come. A typical move up would be about a third of the length of the long ski jump on top of the recent highest peak. In this case, point X would be the region of about 116 3/4. I call it a point, as it is far too early to call it a target so far. Meanwhile, a typical move down will be about 30% off of the long ski jump section, which is then taken off the low of the ski jump. In this case, it would be a moot point as it would be below zero. And that's the end of that quote. So that was a scenario I suppose we were facing at the end of 2019. However, January 2020 started with an immediate monthly key reversal down. That also started a huge move lower. That broke and closed below 2008 low at 36.20 and the more recent 2016 low at 27.10, testing down to the low teens at one point. However, and it is a big however, as I said last year, and here I quote again, the drop, whilst penetrating the newly drawn 2008 to date mildly bearish lower channel line, that's currently at 19 1/4, did at no point close below it. In fact, the penetration lower ended up being a long-legged indecisive spinning top. And that started the move back up. End of quote. Okay, so how did all this move lower and subsequent move back up affect the idea of this supposed descending scallop pattern formed over 2014 to 2019? Well, we did have two consecutive monthly closes below the key level for this pattern. That is the 2016 low at 27.10. However, as I once again said in my exhaustive commentary last year, and I must quote again, I'm inclined to give the idea that it might still be a bullish descending scallop pattern. The alternative is pointless, and B, the extraordinary times and circumstances when it was formed. In which case, we could see that the bullish descending scallop pattern is still running. The move up since May, and that is back in May 2020. It is a stretch, but it can be possible. End of quote. Okay, it is at this point last year that I introduced something new as an idea. This is how I phrased it. And again, it's another quote. The other new feature I'd like to consider is the possibility that the action from 2008 to date may be a huge, multi-year descending wedge pattern. This one is also a stretch, but the number of touches on the previously mentioned bearish lower channel line, yes, that one, has reached 3. If finessed, that is sufficient with the finessed 2+ touches on top. If this is true, then we really have an interesting pattern in the offing. End of quote. I then proceeded to shoot my idea down. With how I'd finessed the upper trend lines, you can still see what I mean today. This is why I call my commentaries Eddie's crayons instead of Eddie's sharp-pointed pencil. I was not happy about this back last year and this year, with the 3 downtrends ranging currently in between 66.15 to 77.35. Well, it's not ideal to say the least. However, it does provide a solution to what may be the dominant pattern here. The jury is still out this year on both of these ideas, and it was, as I added towards the end of my commentary last year, that I quote, and I think this is for the last time, it may take more than the year of 2021 to answer the question. End of quote. So what can I say about 2021? Well, is that we have seen a strong uptrend, currently at 76.34, that has driven the market higher, up through the significant resistances of all the moving averages, plus the 2 significant 50% Fibonacci lines at 51.37 and 65.87. We have seen a move below this uptrend, but no closes below it. The nearest was last November's close right on it. We have also seen the market pierce all, that is, all the downtrends, optimized or not, though as you can see the situation is unclear as to which of the 3 is the more important, or whether we have a real break higher or a false break. The halt of the market at the end of October, just under the 2018 high, 86.74, if only by a few cents, has made this very difficult to determine if we do indeed have a true break higher or a false break. However, I feel obliged to detail potential points topside just in case. This move higher proves, well, just in case this move higher proves to be true. For this purpose, I'll use the lowest of the broken downtrends, the optimized 2012 to date downtrend, currently at 66.08. This gives a potential topside point in the 137.25 area. It's still a point, as I'm not certain as to whether this pattern will work through. We are, after all, still testing the area around any possible break of the downtrend. But that is what it looks like right now. Countering it, well, we need to have closes below all the moving averages and the 50% Fibonacci line at 51.37. Confirming it, though, we'd need consecutive closes over the 86.74 high from 2018.